Thanks for joining us for today's episode of The Capitalist Investor. You got Mark and Diamond Hands D.
Mark, what's going on, man?
I am, what's going on? Not much. I'm feeling pretty good today. It's beautiful outside.
It is. It's gorgeous.
I gotta get back into my golf game soon. You know, I'm starting to pick the clubs back up this season. It's tough for me coaching baseball.
Yeah.
You know, I really don't get any free time until July.
Yep.
But I'm getting ready, dude. It's right around the corner.
All right, we should get out there, man.
We will.
I've barely played it all this year. I need to start hitting it.
Yeah, let me go hack it up when no one's watching me first, and then I'll go with you. All right? Deal. All right. So for today's show, I came across a study that I found to be pretty interesting, and I want to talk about it because it's really not what I would have expected. But this study says that 1/3 of Americans plan to retire later due to COVID-19. And I guess at first glance, a lot of people might say, yeah, that makes a lot of sense.
Right.
Makes a ton of sense. But here's the issue with that, D. From January of 2020 through mid-June, the S&P is up 33%. Okay?
Yep.
So, we'll just pick some round numbers.
Okay.
We'll use $1 million. If you have less than that, don't feel bad. If you have more than that, that's great too. We're going to use $1 million. If you had $1 million on January 1st, 2020, and you were kind of staring at the finish line, which is retirement, you now have, well, assuming it was all in stocks, which it probably wasn't, but again, let's keep the math simple. I'm not that smart. All right, so $1 million is up 33%. By my awful math estimates, you have $1.33 million.
Right.
It sounds like a nice chunk of change.
Yeah, not a bad time period there.
Sounds to me like if that happened to you, you would think it is easier to retire, not harder.
Yep.
Okay. Now let's look at a different time frame. From January of 2020 until the bottom on March 23rd of 2020, the S&P was down 31%.
Right.
That sounds like $1 million goes down to $690,000, D.
Right.
Does that sound good to you?
It is a tough pill to swallow for sure.
Yeah, that's rough. So it's got to be a tale of two tapes here, right? So you had $1 million on January 1st of 2020. You're probably either down. Maybe down as far as down 31%, which would have you at 690 because you sold at the exact bottom and you have not gotten back in. Or you rode it out and you're sitting pretty with 1.33 million right now.
Right.
Based off of this, I guess the headline of this story, 1/3 of Americans plan to retire later due to COVID-19. I would think that there's a good chunk of people that sold. They panicked, there was fear, and they made some pretty bad behavioral finance errors.
Yep.
I don't see how else we can arrive at 1/3 of Americans are going to retire later, unless a lot of people made some pretty big mistakes.
Yeah, I think you nailed it on the head there, as always. What this pandemic has done and how people have reacted to it, I think kind of brings to light a lot of just financial planning issues in general. And behavioral finance is kind of just the natural emotional reaction that people have when the market fluctuates, usually when it fluctuates down. And I think you could tell just by watching TV, listening to people talk, going on Twitter, there was obviously a lot of panic. There was a lot of uncertainty. Yeah. No one really knew what was going to happen next.
Yep.
It was a daily grind. It was tough. There's no doubt about it. But that is when your behavioral finance background and how you react to things becomes even more important, right? Yep. It's very easy to stay the course when your account goes up every quarter that you get the statement in the mail.
It's really easy.
So, that is not how it always works. And sometimes you have to remind people of that. The market just doesn't go straight up. Companies just don't go straight. Stocks don't just go straight up just because they're a good company, right? So how people have reacted to this pandemic really shines a light on what their overall financial health was and how their financial plan was built.
Yep. All right. So a couple things I want to hit on that were jogged in my mind as you were kind of going through your take there. First things first, retirement savings have been disrupted.
Yep.
Okay. So I think you and I both know that if we had $1 million sitting in cash and had an opportunity to throw it all in the market on March 23rd of 2020, hindsight being 2020, I think we would. That's funny, 2020. I think we would both throw all of our money into the S&P 500.
Right.
Because you probably doubled. Right. But the weird thing, dude, is this. It says there's so in December of last year, 22 million people had stopped putting new money into their retirement accounts.
Yeah.
So while they were panicking, they lost the opportunity to buy in when the S&P was at rock bottom.
Right. A big, big mistake. That is, I'm sorry to interrupt you in mid-thought, but that is the whole power of saving into a plan like your 401k, because you get a dollar cost average in there. And when the market's down, you buy more stuff.
That's when you want to double down if possible. I mean, you probably can't because maybe you're already maxing out your contributions, but man, if anything, I would want to save more money when it's down.
Right.
That's dollar cost averaging 101. I mean, that's going to boost your returns over time.
Yeah. And again, it was a tough time though. People thought they might have needed to have that cash on hand. People thought if they were investing more that it was going to go down. Obviously didn't see the light at the end of the tunnel since we can barely see it right now.
Yeah.
But yeah, it's really having those convictions inside of your financial plan and saving into your plan at work is really one of the most important things you can do.
Yeah. All right. So I agree with you that times were tough. People didn't know if they were going to have jobs. How many rolls of toilet paper were they going to have to go and hoard, right? So they had some big purchases they had to make. But even as of March, there were 14 million, March of this year.
Right.
I think everyone feels like we're kind of in the clear or at least getting to that point.
Yep.
And as of March 2021, 14 million fewer Americans were saving for their retirement. They paused their contributions.
Right.
That's crazy. That's crazy. That's just, we could go into a whole behavioral finance episode here, which I don't want to do. But, this is behavioral finance 101. I mean, you cannot make these kind of mistakes and expect to realize good returns over the long run.
Right.
Which leads me into the next point I wanted to make, D, which is something we've seen, a million times already, right? So if we go back, 20 years from January of 2001 through the end of 2020, had you invested $1 or all of your money into the S&P in January of 2001 and rode it all the way through, not making any changes at all the way till December 31st of 2020, your account was up about 7.5% over the course of that time frame. If you miss just the 10 best days, it's more than cut in half. It goes down to 3.3%. And if you miss the 20 best days, that's zero?
Yep.
We're pretty close. 0.69. 0.69. That's not good. That's missing the 20 best days. And if you think about it, D, how many great days did we have after March 23rd? Where the market may have been up 3%, 5% in a day.
Oh, yeah.
A lot of them. So if you went to cash on March 2nd, 10th, 12th, 23rd, whenever it was, you missed most of those good days.
Right.
And you completely crushed your annualized return on a going forward basis. And it's tough to make that up.
Absolutely. And that's what we can kind of look back now on and reflect, after the fact.
Yep.
Again, it's not easy to be making these decisions, in the heat of the moment and with all the stuff going on. But these things have obviously not the specific, pandemic, but there have been blips in the market. There's been bad things that have happened that have caused the market to go down. There are history lessons that we can take a look at and kind of apply them forward.
Yep.
And we've talked about it on the show before. It probably was fairly easy to get out of the market in a
Yep.
reasonable amount of time. When it was, heading down very quickly, you probably could have got out, minus 10, minus 12%, something like that. The difficult part in this scenario, looking back now, was when to get back in.
Yeah.
Because the market started rebounding, at least in my opinion, way before it should have.
Yeah. Yep.
It was that was the tricky part in my estimation. And what you just read off there really shows that. It is, if you miss those good days, those big rebound days, you're going to end up behind where you would have been just by letting it ride out.
Yeah, I agree. All right, so here's something I kind of want to go through. I think this will be interesting for our listeners, because you and I were both kind of looking at this like, accounts are up 33% since January of 2020. How is it possible that 34% of workers feel less confident? Mm-hmm. How is that possible? And 23% of retirees feel less confident. So I found this interesting. So I'm assuming this article came from the Employee Benefit Research Institute, which is where I pulled this stuff from. But this kind of breaks down, D, which categories of people cause that less confident number to go up, right? Which categories of people feel less confident? So where did that differential, where did that delta come from? Mm-hmm. And if we kind of go through it, those people who are in not as good of health, those people who are in fair or poor health, 56% of them feel less confident versus 28% for those people who are in good health.
That's interesting.
So that is and I guess that obviously this was a health scare. Right. So that's an area of distressed confidence, right? When you think about it, healthcare costs can be pretty high in retirement, and probably those people with some pre-existing conditions are they're not feeling as good about retiring right now. Okay. I'm sure there's also a large group of those people who would rather retire because they don't want to go back to work, so, but I found that to be interesting. So that was a big diff right there. The next one is lower household income. So if your household income was less than 35 grand, you're at 52% of people are less confident versus 28% if they're making 75 grand and above. So that could be that could be due to the fact that the people that are making less than 35 grand a year didn't realize that 33% gain in retirement assets. Maybe they don't have a lot of investments that went up. So I think that's kind of interesting as well.
Yeah, absolutely. Yeah, it is, again, looking back at things and how all this went down, it is very telling that everyone out there basically has their own opinion on how things went down, and your confidence as it relates to finances, depending on where you fall into line here, is it's eye-opening for sure.
Yep. All right, next up is those people who have less than $10,000 in savings or investments, which is kind of what we just alluded to, right? 49% less confident versus only 26% less confident if you have 100,000 or more in savings and investments.
Yep.
So, a lot of these, I guess when I'm looking at this stuff, D, I'm thinking almost exclusively about like us and our clients. People who have saved, have invested, and they've got a nest egg.
Right.
So I sometimes forget to remember that there's a whole nother group of people out there who are not clients of our firm, right? Who are living paycheck to paycheck, who don't have savings, who don't have investments, and this beat them up a little bit. Right. So I found that interesting. We then go on to people with a lot of debt are feeling less confident, which is weird because credit card debt overall has come down.
Right.
Delinquencies are down. But when we look at people with a major debt problem, they're 47% less confident versus people with no debt problem, only down 23%. Guys.
So it seems like I have some more numbers here too about general retirement savings, but it seems like what this pandemic has done is kind of brought light to people's financial issues that they already had.
Yeah.
So like the savings is something that really came to mind for me when I was preparing for this show. It is pretty eye-opening to see how many people, when that paycheck got turned off for 2 weeks, that was a huge issue for them.
Yeah.
It's the number of people with zero retirement savings is 25% of workers. But also what I found crazy was, and these are 2021 numbers from PwC, one of their most recent surveys. 13% of people who are over 60 have $0 in retirement savings.
Yeah.
That's crazy.
That is nuts, man.
So yeah, you said it.
And you're relying 100% on Social Security at that point to save the day.
Mm-hmm. Also in that study, only 36% of people feel that their retirement plan is on track.
What percent?
36.
Well, that's not good. It sounds like they need to get a retirement plan.
Yeah,
I might know a guy.
Exactly. So, we talk a lot on the show about financial planning and things like that, but if you even have a plan, you're ahead of the ball game, right?
Yeah.
You're ahead of the curve.
Without a doubt.
And if you can work...
At least you know.
Right, exactly. Knowing is half the battle. So, just coming up with, even if it's a simpler plan, again, based around, emergency savings, getting that on track. Because again, people are living paycheck to paycheck, but there's also the spending that can be a problem, right? It's buying that new car before you put $1,000 in the bank, or upgrading your next vacation before you put that money in the bank.
Yep.
So it's not always the most fun thing to talk about. Sometimes it's like going to the doctor, right? But you have to start with the basics. And I think this COVID-19 pandemic has really brought a lot of those issues to the forefront, which I think is why people are starting to respond this way on these types of surveys.
Yeah. All right, so I'm going to skip over some of the, whether or not they have a defined contribution plan, defined benefit plan, all that stuff. There's 3 at the bottom here that I think are interesting. Mm-hmm. So the one is married versus not married. Those people who are not married were significantly less confident than those people that are married. Mm-hmm. Okay, maybe that's the dual income thing. Maybe it's just having someone else that can make you feel better about yourself.
Right.
But it goes from 41% to 30%. Mm-hmm. All right, so 41% less confident if you are not married. Then we move into college degrees. So those people with less than a college degree are less confident than those people with a bachelor's or higher. Mm-hmm. So that's 40% versus 31%. That makes sense.
Yep.
Right. So a lot of this stuff is pointing towards, if you are educated and you are in a higher paying job and you have saved for retirement and you've got a decent nest egg, all of those things, which makes up, a good chunk of our clients. I wouldn't say every single one of our clients checks off all those boxes, but you're probably feeling more confident today.
Right.
But for everyone else, which is a large percentage of the American population, you are feeling less confident. Mm-hmm. Okay. The last thing I want to hit on, which is very strange to me, is women are much less confident than men.
Yes.
Women at 38% versus men at 30%. I wonder how much of that has to do with some of them being forced to stay at home and coach their kids through Zoom classwork, and maybe forego the opportunity to work. I wonder why that happened. That's very strange to me, but I think it's something worth calling out because, a lot of people have been talking about wealth equality and from a racial, social, gender standpoint, right? Mm-hmm. So I found that to be interesting.
For sure. And I'm looking at just a little different study. Again, this is from the PwC. 56% of male pre-retirees say they were secure in their retirement savings compared to 40% for women. So just a little different take, but that was one of the things that jumped off the page at me as well.
Yeah.
And I don't really have a good explanation for that one, quite honestly.
Yeah.
I really don't.
So here's what happened. So it was let's see, pre-retirees, and then All right, so in January of 2020, 61% of men were confident, and it went down to 56%.
Yep.
Okay, so let's start there. So it seems like when I look at these numbers, males have always been higher than females.
Right.
Okay. But let's just talk the delta. Like how much did this actually beat up your confidence as it relates to retirement? Okay. So when we look at the delta, men went from 61% down to 56%. So that is a 5% drop.
Right.
Women went from 54% down to 40%. It is a 14% drop. So it's not just like the headline number, D, but it's also the change that I think is most important, because that's the change that was a direct result of the COVID-19 pandemic.
Right. So, yeah, I mean, that's a huge drop-off. And it's great that you can compare the pre versus post-pandemic.
Yeah.
But that's a really big drop for the confidence of women there. And, again, I think wages were affected a little bit more for women than for men, but not in such a big way, right? The 14% delta there.
Yeah.
So it's just one of those things that we're going to have to see play out, because I don't have a great answer as to why that is.
Yeah.
But you can definitely tell. And honestly, I think you can tell just by talking with people, me talking with my clients as well. It seems to be the case overall, but again, I feel that's kind of a big generalization that women are just more worried about the aftermath of COVID than men. So yeah, I don't know. What do you think?
If I had to put my finger on it, man, I would assume that in the pre-retiree category, some of it has to do with a higher percentage of women not being able to get back to work because their kids are at home being Zoom schooled.
Right.
So, again, I'm just making that up, man. I'm just giving you my gut feeling, but I think that may have weighed on it. I don't think it's just men and women have different psyches as it relates to retirement planning. There's got to be an underlying reason, and that's the only one I can really think of off the top of my head.
No, that's a good one.
All right, so we kind of went through this. What do you think are the key takeaways here? What should people do to make sure that they're not stopping their retirement savings when they should be cranking it up and dollar cost averaging in? What are your takeaways from this study and from this episode? So
that's a great segue to kind of what I think. There are two things in my career that really stand out that I'll never forget. Number one is not a specific timing or not a specific time. When we would teach these college education classes, retirement classes, in multiple settings, but the ones I did the most were in a classroom. After every class that I taught, it was like clockwork. At least 2 or 3 people would come up to me and say, "Hey, man, that was a great class. I really enjoyed it. I wish I had done this 5 years earlier. I wish I had done this 10 years earlier."
Yeah.
I know you've had the same experience there. It's never too early to start this stuff, and it doesn't even take that much time, especially if you're younger. You mentioned before, just knowing is half the battle, right?
Yeah.
Everyone has to start somewhere. And if you're at the beginning, that's fine. But educate yourself as to what you need to do to get into a nice retirement.
Yeah.
So that's my number one thing.
Start with a plan, I think.
Yep.
You start with a plan, and the plan should guide you and kind of hold you accountable. And it's not going to do everything,
right?
But at least it gives you some perspective, right?
And the second thing is, I've mentioned this before. I'm not sure if it was on this show, but I taught a class, and essentially 3 years went by, and I got a call out of the blue from this lady who said, "Hey, Derek, I don't know if you remember me or not, but I took your class 3 years ago.
Wow.
And I'm ready to retire. I'm actually retiring in 2 weeks. So I think I'd like to come in for that consultation now."
That's great that she's doing that, but I've used that in classes that I've taught where it's like, you don't have to wait until like you've handed in your papers.
Right.
In fact, it's better to start as soon as you possibly can. You know.
Yep, for sure.
I don't want to cut off your story.
Oh, that's all right. You know, so I was like, sure, you know, come on in. Let's talk. And there was just some very elementary stuff in there that had we talked 3 years ago, I mean, I don't even need to work with her. Had we talked 3 years ago, I would have been able to point her in some better directions.
Yeah.
Even, like I said, without working with me. But at that point, she was pretty much locked into what she had. Couple of, you know, commission-based investments that didn't perform very well over that time period, that could have been used in different ways. So again, it's never too early to start, whether it's listening to this podcast or checking out some of our videos or, you know, talking with an advisor in your town, whatever the case may be, you know, try to at least get to first base, if you will, you know, get that single, at least know where you stand and what you need to do to get better position for retirement.
Heck yeah.
And that will allow you to at least feel more confident when bad stuff happens, because more bad stuff is going to happen. I'm not sure when it's going to be, but it's going to happen. It's not going to be, you know, just smooth sailing from here on out.
No doubt, man. All right, so I love everything you said. I'm just going to add one little layer of things that I'm kind of taking away from this. You mentioned the college classes that we used to teach. And one of the things that we kind of stumbled across while we were teaching those classes, and sometimes we'd actually refer to it as we were teaching, was that Vanguard report. Vanguard did that study they were trying to quantify the value of a financial advisor, right? Which is, it's tough to quantify.
Right.
And the thing I like about the Vanguard study is Vanguard did this study at a time when they employed 0 financial advisors.
Right.
So it was completely independent and unbiased, which I think that's the way a good research report should be.
For sure.
Right? And they tried to quantify the value of a good financial advisor, not someone who just gets paid to throw you in an asset allocation strategy, but someone who's looking at, you know, distribution planning, like how do we get your money to you in retirement, tax planning, all that stuff. And if I remember correctly, D, the value of behavioral coaching was about a 1.5% per year.
Right.
150 basis points of additional performance without that advisor picking better stocks, mutual funds, better investments at all. Your performance went up by 1.5% on an annualized basis just because you had somebody protecting you from your own worst enemy, which oftentimes is yourself, because you panic.
Yep.
Right? So that to me is what kind of, you know, rings true front and center. You got to have a good behavioral coach, right? And look, we've got a lot of people listening to this podcast who like to invest on their own. That's cool. So I love it. I love the fact that you love to invest on your own. That's great. But I also think striking some balance is important. So we'll go back to that $1 million number. Maybe you just absolutely love watching CNBC and Fox Business all day long, right? And you like to act on some of your favorite stories that you hear throughout the day or throughout the week, year, whatever it might be. As you're doing that, if you got $1 million, you need to figure out, like, all right, how much of that money should I really have managed by someone else who is not going to let me do what I'm not supposed to do?
Right.
You know, how much should I outsource? And maybe that's $900,000, and maybe you keep $100,000 and you tinker with it, right? And if that $100,000 that you're managing goes down to $50,000, maybe at that point you decide to hand that over too, right? And just enjoy, you know, pre-retirement and retirement instead. But I think striking some balance to make sure that you've got a behavioral coach is I think that's the most important takeaway for me, D.
Yeah, for sure.
All right. So that wraps up today's show. As always, shoot us over questions, info@swpconnect.com. Feel free to ask us questions. Give us some topics that you may want us to talk about on future shows. We'd appreciate that. Give us a 5-star review. Hit the subscribe button. Let your friends know about us, and we will talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.